Welcome back to another video in the Smart Money series. Today, we're going to be going through liquidity. I think this is the fourth video in the series now. I'm sticking with a format where in the first video, we essentially cover a concept, go through understanding what it is, essentially how it works, what's happening behind the scenes, sort of, and then in the second video is essentially where I will show you how to actually apply it onto your charts and how to use it to trade and make money off of it essentially. I think it is important to actually understand how these mechanisms work in the first place, because if you understand that, then you can apply them properly and you're going to know in which scenarios or which setups they're valid or they're not. But let's get into liquidity. So what is liquidity? First thing I want to talk about, with liquidity, there's different definitions in different contexts, right? The context that we're talking in is within the market. On our charts, there's liquidity or zones of liquidity. So liquidity in the market, as I've said here, usually refers to areas where orders, including stops, limits, stop losses, and take profits may reside. This liquidity can be engineered and manipulated into existence as a large majority of traders attempt to buy or sell from the same levels or place their stop losses in similar areas. This usually results in liquidity being taken out. So what this means is, if you look over here, this blue line is our price, right? So this is a range, by the way. When price is just going sideways, we're consolidating. This is known as a range, going here, here, here. Price is touching. Why is the liquidity marked out in these zones? Because what's happening is, one, a lot of people are buying. So now that they've seen price hit this, then hit this, then hit this, and now price is coming down, where's the next logical place to buy? In line with this last low, right? So a lot of people are buying here. The same way you would have seen this, and then people might have even been selling here. And over here, where price is now, let's say, a lot of people will probably be selling. The more touches that this range gets, the more retail buyers, retail traders, sorry, will be attracted to these positions and be buying and selling from the same points. So the reason the liquidity is here, if they're all buying and selling from these points, then what's happening? Under these points is where their stop losses are, where there might be buy stops and sell stops. We're going to go into the orders if you don't know what they mean, but these zones are known as the liquidity because that's where essentially the actual liquidity resides, right? So, like I said, first thing, the definition of liquidity in exchanges, not that this is relevant, but if you want to know, liquidity in exchanges usually refers to the amount of money flowing through the coin or asset. So usually if it's a high liquidity market, there's going to be less fees, less slippage, and all of these other things. But that's a different type of liquidity. Like I said, we're talking about liquidity in the markets, liquidity on our charts. So liquidity is areas that price will gravitate to eventually and look to take out. And I'll get into why it does this, right? But the concept, as described by a very well-known trader, ICT Inner Circle trader, you might have heard of him. He says liquidity and price is like paperclip to a magnet. Essentially, liquidity is our magnet, and then price is the paperclip. So it's gradually always moving towards it. So what is liquidity engineering and price manipulation, right? Let's come back here. Let's look at this example. Liquidity engineering, what's happening is there's other people in this market, the market makers, bigger players. What's happening is when price is coming from here to here, then here, what they're purposefully doing is pushing price down here and then creating this range. Then down here, they're purposefully pushing price up. Why are they doing this? Because they know if they can create this structure, this very well-known structure that's known as a range or consolidation, is a very, very simple concept. So a lot of people are going to be looking at this and trading it. What's going to happen? A lot of people will start placing the orders here, placing the orders here, wherever. So they need to engineer this liquidity to exist. They need to manipulate price, push price in certain directions, up from here, down from here, and create these structures, create these other shapes you see on your chart. I don't know, things like double tops, double bottoms, etc. Because a lot of people trade the most common patterns on a regular basis. And the more people you have trading them, the more liquidity that resides in those areas, or at least around them. So we have something called stop hunts. So a stop hunt, you might see other people refer to it, is usually, so of course in our liquidity zones we have our stop losses. If people are buying or selling up here, what's happening is their stop loss is below or above their order, right? So a stop hunt usually happens, you'll see a large wick. For example, imagine price came down here and then a lot of people bought, price might move off a little bit, more people buy it, and then you see a large wick, a very large wick. This wick will liquidate all the buyers. It will essentially hit everyone's stop loss, take them out the market. So now you're probably thinking, why is this happening, right? That's what I was thinking when I initially learned this. Why are they taking out these buyers and sellers and all these other retail traders? In the market, you have to remember, for someone to buy something, there has to be somebody selling at the given price. For someone to sell something, someone has to be buying it, right? If we're buying something and then later on, so for example, let's say we enter a buy position here, right? And then we sell it up here. When we're selling, we're taking profit. So what this means is that somebody up here is buying from us, right? So the whole point of this buying and selling concept, these market makers, these whales, institutes, whoever, they need this liquidity to make their own profit. Because what's happening here is they're selling, and as they're selling, they're hitting stop losses. And when they're hitting these stop losses, of course, imagine your stop loss gets hit, you've lost money, right? On your KuCoin balance, whatever, you've lost money. The money doesn't go to the exchange, it's going into the pockets of the people who were selling here. If they sold here and you bought here, then your stop loss is here. You would have been in drawdown. So the money that you lost is going into the pockets of the people that were selling here, into the sellers, if that makes sense. I just want to get into the types of orders. Just it's quite a basic thing, but everyone should know what they are and how they work, because if you understand them, it's easier to see on the chart what's happening where, right? So let's get into the stops first. So we have buy stops and sell stops. So usually, same example, let's imagine we have a range. What's happening is people are buying once price has broken the range. Why? Because what they expect is that there's going to be a continuation. You're going to see buy stops used potentially by what we call breakout traders. They wait for a breakout in one direction and then they'll set their buy stops. Um, People trade by different models. I think people have a common thing where sometimes, if price hits this range 6 times, let's say the seventh time or the sixth or whatever, there's different models. Essentially, on a specific touch, they believe it's going to break out. So if price is hit here, let's say 1, 2, 3, and then you think on the fourth time price is going to have a definite breakout, it's going to go in this direction, then what you do is you put buy stop here. When price breaks this range, you'll be entered into a buy. And then, of course, as I mark that, you have bullish continuation. It's the same concept for a sell stop. With a sell stop, you're just waiting for price to break, and then once it's broken out of this structure, it doesn't have to be a range. The ranges, for example, it can be different types of shapes, structures, whatever. Then you have a sell stop placed here. And of course, people might use these stops in different instances, different places, but this is just like the simplest example that I can give you guys. So with your limits, is again, you're looking to buy, but what you're expecting this time is a reversal. You're buying here at the bottom of the range in the hopes that you buy here and then price is heading up. Why? Because we have support here, we have resistance up here. So you're gonna buy in, you're gonna buy here and hope for price heading into that resistance. With the sell limit, it's the opposite thing. You're selling when price hits the resistance and you're gonna be selling into the support. So this is probably the most commonly used order type, I'd say, aside from market orders, but people would use these in all their orders to buy at specific levels, sell at specific levels, these levels that line up with their analysis and the sort of setup they're taking or whatever. The other thing that I mentioned is stop losses and take profits. The reason I mentioned stop losses and take profits, you have to remember that stop loss and take profits reside in these areas, right? So the market is manipulated accordingly. You will see liquidity being taken, and you're going to see stop hunts where it's most favorable for whoever's essentially doing the manipulation in the first place. And you should know what liquidity is, at least to a basic level now, understand the foundations of it. But just some last points that I want to talk about. So when I talk about liquidity within the market on our charts, usually this will make a lot more sense in the next video, so I'm not going to go into too much detail about it, but it will apply to coins with larger market caps, or usually coins on futures, because they're more liquid markets, we could say. You're going to see the concept of liquidity applying forex and other markets as well, but those markets are already very, very high liquidity. What I mean by you'll see liquidity exists in every market. For a market to essentially exist, there has to be liquidity within it, right? There has to be orders flowing in and out. What I mean by liquidity on the charts is, for example, if you have a 1 million market cap, which is a very small coin, nobody is really going to be, on there hunting the liquidity and whatnot. At least these market makers, the people that hunt the liquidity, are playing in the bigger markets where there's a lot more money to make, and they can essentially manipulate a lot more people, because of course a lot more people are involved in those markets. And the last point I want to make, why is all of this liquidity important? What does this mean? And like, again, we will get into this in the next video when I show you how to trade with it, but it gives you an idea of what price is going to do next. If we go back here, right? If price takes this liquidity out, we take this liquidity and then price reverses, price is very likely to head downwards. It's it's because if this liquidity has been taken out, then where's our next liquidity zone? It's down here. It's quite obvious. So what's going to happen is, if price takes this out, it can make sense for price to come down here. So of course, with a pinch of salt, that's not going to apply in every scenario. Don't think you can just jump on your charts, mark out liquidity, and then just trade every single liquidity zone. That's not how it works. But that's just very simple terms. And essentially what I'm saying is, we don't trade when liquidity is essentially taken the first time. We trade after we see what's being done after the liquidity has been taken. So if this liquidity was taken and then price is now reversing, then where's our target? Then price is very likely to start heading towards here, right? And if the liquidity gets taken but we head up, then where's our target? It's going to be the next zone of liquidity up there somewhere. But yeah, hopefully all of that makes sense. If it doesn't, here's all my socials. Contact me on anything, just message me. I'm happy to help. I'm going to be back very, very soon with the next video based on how to trade with liquidity.